morning, everybody. Welcome to the Game Plan. My name is Gareth Soloway, and as always, I am here to help you get through the trading day with all the ins and outs on a technical and data basis. So let's get right into it here. All right, we're going to get right into the charts, see what we got today. We have some data coming out this morning. We have jobless claims coming in at 217,000. Remember, that's people filing for unemployment. So again, there were 217,000 people in the last week that filed for unemployment. Expectations were 217,000. So it was dead on. Now, again, one of the things to remember about this is that generally for the last who knows how long, we've been stuck between this 200 and 220,000 level. And the kicker to this is that that is actually historically low. So far, yes, we've seen layoffs coming out more and more by more big companies laying off 10% of their workforce. But still, for the most part, it's not en masse yet. It's not mass small business. This is more larger businesses that are publicly traded. Now, the interesting thing on that is that generally large businesses have more data on the economy, and they're going to make those tough decisions because they're publicly traded and they have to generate a maximum amount of profit. So they're the first ones to go. This number will start to rise dramatically when we see smaller businesses start to do the same. Okay, next coming out, continuing claims. These are people that are still on unemployment. It actually was a surprise higher number. That's not good. It tells you more people are not finding jobs necessarily, and they're staying on unemployment for longer. It came in at 1.906 million. Expectations were for 1.889 million. Next up, we have another tidbit of information, and this kind of goes to what we were just saying. U.S. layoff announcements rose 3% in the last month, the highest level in 11 months. So again, it's slowly starting to shift. Not enough to really raise this initial claims number, but it is starting to uptick. And again, that's something the Fed's going to pay attention to, and we all need to pay attention to it as well, because I truly believe that the stock market is hinging on this perfect landing. And if we start to see jobs being lost en masse, that will be a kicker for the bigger down move, corrective move in the stock market. All right, next up, let's talk tomorrow's payrolls. Non-farm payrolls coming out tomorrow. This is the big jobs report tomorrow morning, 8:30 a.m. Expectations are for a gain of 198,000. Last month, we saw a gain of 353,000. Now, again, a lot of people will say, oh, these numbers are fake, da-da-da-da-da. It doesn't really matter. I'm a trader. I have to go by what the market deems important. And if the market deems these numbers important and moves on it, I have to be ready for that, as should all of us be, regardless of what your sentiments are. All right, couple other things. The Fed Chair Jerome Powell will testify before Congress today, starting at 10 a.m. Eastern Time. He did this yesterday as well. He'll do it again today. And a couple just other key headlines here, guys, that I just want to point out that I thought were important. Number one, Novo Nordisk jumps pre-market after announcing an early trial for a weight loss pill that it's oral, right? So an oral pill. Again, every weight loss drug out there right now is an injectable, and this is very, very interesting because more than anything, you look at where Eli Lilly is trading, and I personally think it's overdone to the upside. I think competition is going to come, and once you get these oral ones versus injectables, that's going to be the favored. Now, granted, this is only basically in stage 1 trial, but the weight loss was incredible from this oral weight loss pill, and again, it ultimately will be competition over the next few years for Eli Lilly. This is an interesting headline I found, guys. Pinduoduo, PDD, it's a China company, was the top advertiser on Meta in 2023. So they spent the most money of any advertiser on Meta. And again, to me, this is just something that I was a little surprised about because, again, it's a Chinese company. And supposedly we have this, back and forth with China, and we're kind of saying, no, they can't have chips. But yet they can come advertise on one of the biggest platforms in the U.S. to consumers en masse and to the public en masse. So again, something that I just thought was interesting that we should all be aware of. Lastly, this is Victoria's Secret, dropping 30% pre-market after full-year sales guidance fell short. Not a big company anymore, but again, it was a big miss overall. All right, we're going to take this a step further, guys. What I want to show us here is a chart of the non-farm payrolls report. And again, this is going back to 2021. You could see that in general, it's been kind of consistent, but there is a slow downward trajectory to it, right? So again, if we look at this and we look at the lines, we can definitely see here that we've slowly been moving lower lower and lower and lower, right? So again, yes, last month was actually pretty decent. We actually jumped up a little bit. You could argue that might be seasonality. There might have been some other factors there, but there's no doubt that for the most part, we continue to kind of slowly come down. The big question is, where does tomorrow's come out? Now, based on the expectations, 198,000, that would bring us right down into this lower range here. If it comes down lower, close to that zero mark, that would be a new short-term low. Don't necessarily expect that, but I do think that the market is looking for a Goldilocks number. The market wants the Fed to still be open to cutting rates later this year, but at the same time, they don't want economic data that's too weak that says, oh my gosh, we're falling into a recession. So I think anything between 100 and 200,000 jobs would probably be right in that Goldilocks environment. You start getting close to no jobs, that's where the market could get worried. Same thing on the other side. If we come out with another number in the 300,000 range, that also would be a concern. It would basically take off the potential for rate cuts later this year. All right, another key metric that I want to show you guys, and this is one of the ones I'm going to be paying very, very close attention to tomorrow, is the U6. And I've talked about this more and more with you guys because it's so important. So the U6 is people that are underemployed. And when I mean underemployed, it's people that are working at a company and the company says, man, we're not doing so well, so we have to cut back some of your hours. I don't want to fire you because, again, hopefully the economy speeds up and it's so hard to find good quality people, but I just can't afford to keep you on full time, so let's move you to hourly. Or the other side is people that are looking for a job, they can't find the full-time job, they can only find part-time jobs. The thing that I'm showing here, these are recessions, right? So these are recessionary points in history going back to the dot-com bubble right here. And what we can see is that we definitely had a low here before we went into recession, and essentially U6 was upticking. It was a leading indicator. And again, if you look over here in 2007, we had about 12 months of an uptick before we got into that recession. Here was COVID. You saw a little uptick, but COVID was more of a black swan event where it kind of was a sudden hit to the economy. It wasn't as big of a uptick, but look at what's going on right here, guys. U6 has definitely been climbing just over the last 6 to 8 months, and to me, that is an indicator that there's something brewing here, all right? People, again, are looking for full-time work. They're not finding it. They're having to take part-time jobs. When you take a part-time job, you're not included in unemployed, even if you wish you could have a full-time job. Very key distinction. So tomorrow, watch for what the U6 number is. I'll try to find it out by the time I do the stream. Lastly, on this chart, this is just an interesting chart that I want to talk about here. It has in relation to the Federal Reserve. Now, if we look, we see, and again, it might be hard to see on your screens, but there's gray lines here, right? Gray lines up and down, vertical. Now, those lines, again, are recessions. And what we could see is that if you go back to the Great Depression over here, it's pretty even, right? Every 5 years to 10 years, this was kind of the biggest gap right here. This was about a 10-year gap, and that was from 1960 to about 1970. There was no recession. But guess what happened here, guys? In 1977, we saw the Federal Reserve get their dual mandate. And when they got their dual mandate, that was the beginning of the end of the normal business cycle. Now, the normal business cycle is very good for the economy. It's the idea that, think about this. If you never let your body get sick, right? If every time you get a bug, you take antibiotics right away, your body does not build its natural ability to fight off the bugs if you don't have that drug, right? And that's the kind of the concept here. So the idea is that a business cycle should generally be like this, right? Gentle rolling hills where the economy slowly does better and better and goes up and up. So the trajectory is longer term up like this, but you have natural recessions along the way. That's the normal healthy business cycle. It's basically a way to flush out the kind of the weak hands. It's almost Darwinian in that way where you get rid of the junk. All right, that's what a recession does. It cleans out the system, it lets the strong survive, and you go on to your next cycle, et cetera, et cetera. The kicker is this, is once the Fed got the dual mandate, they started tinkering. Dual mandate, by the way, means maximum employment and stable prices. And once we got that mandate right here, right, look at what happened. Is yes, we had recessions, but they started to get further and further apart. In fact, you could argue that if it wasn't for COVID right here, right? This was COVID. You have not had a recession since 2008 and 2009. We're now at a point where that's 15 years. And again, it's because the Fed is artificially injecting liquidity. Part of that is also U.S. debt that the U.S. keeps spending, which is the same thing, right? Stimulating the economy artificially. It's not allowing for natural cycles. And this is where it comes out to be, where eventually what you're going to do is when you have these things where you have long-term, right? You have long-term expansionary periods. What do you get when you have a long-term expansionary period? Eventually it collapses. The problem is it's a huge collapse. It has to reset. And it's so much more painful than a natural, gentle, rolling recession, contraction, expansionary period. And that's my biggest fear here. In addition, you can see the results. Look at when the Fed was not in their dual mandate, how the markets behaved. Slowly grinding higher, slowly grinding higher. This is when the Fed, again, Fed mandate comes in here, you start to get more vertical. Then you go up here, Fed intervenes, we get the bigger collapse, which is the Great Recession, right? That was, again, because there was a lot of interference in the Fed in here, not allowing that to happen. And ultimately, we then get this mega move to the upside. And that's the fear, folks, is that what we have to recognize is who knows how long they can stave off the inevitable. But eventually, it has to come back to roost. The system has to reset. It's the natural order of things. You can only postpone it or keep the patient alive for so long on the artificial drugs. All right, guys, I want to get into some other charts now, but I just thought that was a very interesting thing to go over today in the charts. So again, as we go through the S&P 500, here's our classic wedge pattern that continues to hold closer and closer. And again, we can see that just 2 days ago, we were up here, then we came down here. Let me switch the color of that so you guys can see it on the black background a little bit better. We got a bounce yesterday. Today, we're trading slightly higher. It looks like we're going to stay inside of this going into tomorrow. Now, tomorrow, we know we have the non-farm payrolls report, right? So again, the likelihood is maybe, let's say we end in this middle range right here going into that non-farm payrolls. I would dare say that there is a decent chance that tomorrow's market move will either close us below this line or above this line. And again, it won't take that big of a move as this narrowing wedge pattern continues. So again, we are very close to a pivotal factor here, a pivotal break or breakout, breakdown or breakout. The question will be is if we break down, I'm in the case that we'll see a 10% correction. I think at minimum 10% correction in the case of that. All right. Going to the NASDAQ 100, same kind of deal, guys, right? We have this same general pattern. We've kind of pierced to the downside a few times, but never confirmed. You can see, again, it's up here. If we break this level, right? So if we break this level and confirm, the next major support on this is not until you're down here. That is a big time move from about 440 on the QQQ down to 380. So you're talking about potentially a 20% drawdown in the markets before you get to this major technical support. Now, where's this technical support coming from? Well, basically what you do is you zoom out on the chart, right? So we look back and see, and let me just jump there. There we go. We zoom back and see, and we say, okay, well, this is connecting the short-term lows here. That gives us that line. If that breaks, where is the next major pivot low connection trend line? And the answer is going back to the 2023 lows, connecting it through this pullback in October of 2023, and that gives us this level right there. In addition, we always look for the confluence, right? The confluence of levels to give us a firmer signal. What we look at here, where do you guys see that line? Well, look at this top. If we go to the top, going back to 2023, and we put a trend line right there, what do we get? Almost identical level right across. And so now what I see is that if we did fall, let's just say we fall down to 380 on the Qs, that tells me that's going to be a major bounce level. So again, it's not about being all the time bullish or all the time bearish. What you need to do is you need to say, okay, well, up here, clearly overdone. If we break here, we get the big move. All right, that you can go short there, but where do you cover your short or where do you flip it into a long? That would be this level right here for at least a technical bounce. Okay? Let's keep going on these charts here today, guys, as we go through. Let's flip through a couple other big names. So we do want to just kind of continue to mention Apple. This is the weekly chart of Apple. You can see that it has really broken down. And again, Apple now, I actually think what's going on here, guys, and we see like NVIDIA up pretty much every single day at this point. But my guess is money is coming out of Apple and actually rotating into NVIDIA. In fact, yesterday we had pretty much all of the Magnificent Seven down except for Meta and NVIDIA, right? And again, so you're seeing a lot of these other high flyers that are like older, not as cool anymore, even Google and Amazon coming down. But again, Meta's still hot. Again, we also see NVIDIA still hot. But looking at trend lines, right? What do we have? We take that same kind of metric. We go back to our COVID low. We connect it right through here. And again, it gives us this anywhere between, I would say, right around 155 to 160, confluence of levels right there. There's also a retrace Fibonacci level right below 150 or right around 150. That will be a major support level. Now, again, is that a long-term buy level? I have no clue, frankly, guys. I mean, again, the long term is so hard to predict. All I know is if we come into this and it's only really about $10, $15 away, I would probably be looking to buy Apple for at least a swing trade bounce. All right, and again, that's a swing trade, right? So it doesn't tell you long term. It just tells you at least in the near term, you look for a 5, 10% bounce on Apple, then you move on to something else. Let's look at Tesla, speaking of something else. Tesla continues to be struggling here. So we had a great bounce on Tesla recently, but it has reversed to the downside. Now, where the heck does this start to look interesting on the charts? And again, what I want to do is I want to take that same COVID low and I want to connect it to the most pivotal low right here and drag that trend line out. And when I do that, I get a major technical support at around 135, right? So again, same kind of deal. As this stock collapses down, it's trading at 176. It might seem like a long way away, but for Tesla, that's not that far away. This stock moves very, very quickly. And again, just looking at that, we have that level to that level. If we get down to 135, let's say 136, you should also get a bounce of decent proportion. Notice this low right here. We draw that across. It's virtually right at that same level. Nice confluence of levels as well. All right, next up, Microsoft. Now, Microsoft's an interesting one. It stayed strong, but look at what we have here. We have a channel that, again, if we take the low here to the low here and the low here, and we do a parallel line straight up, we get this exact high and we get this recent high. So is it possible Microsoft has topped here? It absolutely is. It's a little early to be sure on that, but certainly based on history, we would assume this would at least get some sort of decent retrace. The first support here is going to be around 375 right there. If that breaks, then you're looking at this level right in here. Also, again, one thing with the 350 level, why one of the reasons I would like that is I'm just eyeballing this, but there's a general, if we connect here and here, and I apologize for my non-ability to draw straight lines, but generally it looks like there's an upsloping trend line right in that same area. So I think you have minor support at 375, but if this were to dump to 350, that becomes a major technical level. Let's keep on going, guys, here as we go through. We're going to flip into crypto in a minute, and we'll do a few others. Amazon, to be honest, I don't have a whole lot on this. This is one of the few mega caps that hasn't made a new all-time high, so I'm kind of stepping back on it. Again, you have to think that there's a possibility at least it could touch this double, triple top up here, but again, certainly has gotten extended, but it's one of those that I don't have a great read on right now. Lastly, quickly looking at this, we have a breakdown on Google. So Google, same kind of deal, guys, right? We had the same upsloping trend line from here to here and broke it right here. We've now broken. You'll have some support around 120, but the big level comes in right here at 100, right there at 100, which is also right in this range here with this top, and this area right there. So again, good level at 100 if it continues to come down. Now, again, for me, I still continue to think that the semis are the reason this market is being held up. If the semis give way, and again, looked at that Q's chart, that breakdown of that wedge, that tightening wedge, same thing with the S&P, that I would guess would coincide with a pullback in the semis should that happen. Bitcoin, let's go into Bitcoin real quick. Bitcoin trading around 67,000. Again, hasn't taken out the 69 high that we made a couple days ago and had that flush, but certainly we have bounced back. On a technical basis, I think Bitcoin could potentially continue to go higher. There's always that chance. What you'd watch for is a daily close below this trend line. See this trend line right here, from here to here and right up through here. So if we start closing, let's say we get a daily close below, looks like 63,000 or so, then I do think it's vulnerable to actually correct back to 50 to 52,000, possibly even as low as 49, which would be that former level right there. Couple other crypto charts just to go over. We'll touch base on Ethereum, which remains very, very strong. We can see, again, this is your weekly Ethereum chart. If we zoom in on this, we can see it's taken out this high. We have a couple little levels here. There's a level around 4,000 that is this former high right here. But for the most part, honestly, you know, yes, it's extended. I mean, this is a weekly with 2, 4, 6 straight up weeks in a row. But at the same time, it's looking more and more like there is a potential to get back to at least double top on Ethereum. Okay. Couple other charts here I just wanted to go over with you guys. We have to look at gold, which continues to be strong. Again, amazing breakout on gold has continued. Now, again, this is a chart that's getting extended. You guys know I'm a huge longer-term gold bull. And when I say longer-term, my horizon's like 12, 18 months out. So some people, the long-term is like 20 years. That's not for me, right? So I differ from day trading, which is intraday in and out, to swing trading, which is like a month or a week or a couple weeks in and out. And then you have my long-term, which is like 12 months kind of. Longer-term, 12, 18, 24 months, continues to go higher. But just in the short term, honestly, this is getting extended. I would generally anticipate that it would not surprise me to see a check back to the former scene of the crime, again, going back. So just be ready for that. If it comes back to this level, 2075, that's actually generally healthy. That's kind of a check back to home base to gather strength again before its next move. If it closes and confirms below there, then you get a little bit worried. But for the most part, it has been a beautiful breakout on gold. Quickly touching on silver, guys. Silver has actually had a very nice move as well, but clearly it has not broken out. You have to get above this downsloping trend line here. And again, just looking at this, if we zoom out on this, I mean, this wedge pattern goes back a long way. Look at that. So you're going all the way back to your 2020 highs up here and up here, right? All the way through. And again, we're up here at just a 24.30 or so. You need to get above 25 essentially and confirm. Then you can start talking about a breakout, which should then yield a move back to your $30 level up here. But as of now, silver, great move. But unlike gold, it has not broken out yet. I think part of that is that it's an industrial metal more and more versus a store of safety, and that causes an issue. Lastly, I know some people wanted to see Palladium. Palladium had a great move yesterday. But ultimately, again, for the most part, this has been beaten down. In terms of levels of resistance on Palladium, I think the one thing you would do is you just zoom out on your chart. So just like we were connecting high pivots prior, you would connect or low pivots prior on those other charts. We would look at this and basically say, all right, well, you have this downsloping trend line. If we get back into this at around 1110, that's going to be resistance. Then we have to watch to see if it breaks out. All right, guys, a lot to cover. I know, as always, it's awesome. I do thank you guys, as always, for being part of it here. Again, thank you guys so much for tuning in. Remember the wheel, guys, the wheel again. We are going to be spinning that. We're just filling out the final spots, and then every single day, we're going to be rocking and rolling here, all right? So, again, guys, thank you for tuning into the game plan. I'll see you tomorrow. Take care.